Guys, NVIDIA just reported revenue and profit. We're going to cover their earnings release in just a few seconds, but there's a lot of talk about NVIDIA being a bubble. We're going to break that down and see if we think that's the case. Mo, take it away. What did NVIDIA report?
All right, NVIDIA has reported they are up right now 6%. I'm going to read it right here from NVIDIA themselves. Earnings per share of $5.16, beating expectations of $4.64. Revenue of $22.1 billion versus $20.55 billion expectation. A few more numbers here. NVIDIA's Q4 data center revenue, $18.48 billion versus $17.21 billion. Adjusted gross margins for the fourth quarter, 76.7% versus 75.4%. This company just doesn't stop. It just absolutely doesn't stop. Look at these. I'm just going to start scrolling through the press release here. Record quarterly revenue, $22.1 billion, up 22% from Q3 and 265% from a year ago. Data center revenue, up 409% from a year ago. Record full year revenue, up 126%. And as we just continue on, these record numbers are absolutely mind-blowing. And here we're going to look at GAAP versus non-GAAP. And just look at the comparisons. I mean, over here in Q4, 6.05 versus 22.1 billion. Absolutely insane. Come and look at their operating income. 1.25 billion a year ago. Today, 13.61. That's up 983%. This looks like a company that is a growth company that has only been around for a couple of years, but it's NVIDIA. They've been a staple everywhere. Actually, I'm using an NVIDIA graphics chip in the screen in front of me. Look at these financial summaries for fiscal year 2024. $60.9 billion in revenue total versus last year doing a full year of about $27 billion. Just something. And when you come down here to their outlook, and this is probably what people are looking at as outlook, and that's why the stock price is moving up now 7%. Expecting $24 billion plus or minus 2%. When you come to GAAP and non-GAAP gross margins expected to be 76.3 and 77% respectively, plus or minus 50 bips. Guys, they just don't stop. They just do not stop. And here you have the integrations that they've came up with, the partnerships that they've come up with. They've launched in collaboration with Google for some AI platforms. They've started working with Amazon Web Services. The list goes on, and I do not see these guys slowing down anytime soon. Fourth quarter revenue of $2.9 billion just from their gaming side, up 56% from a year ago. Just amazing. Everything that they're doing, they're firing on all cylinders right now. I cannot wait to see what this company does in the future. They are now up almost 8%.
All right, so let's break down NVIDIA right now. Guys, NVIDIA has been on a meteoric rise. If you look just in the last 1 year, it's up over 230%. In the last 10 years, it's up 14,000%. That is insane. That means you made 140 times your money, essentially. 140 times in just 10 years. And it's not like the company was small 10 years ago. It was over a $10 billion company at that point. They've done a great job with AI, but this recent run up in just this year alone, they're up over 40% this year alone. That's incredible. For a company as large, a $1 trillion plus company, to be up over 40% in just the last 6 or 7 weeks is an insane number. Feels bubblish. Now, a couple of things that we don't like. PE and 5-year PE, insanely high. Closing on 400, right? Now, if they were going to double their earnings for the next 10 years, that would be nothing, right? The question is that an appropriate assumption? Now, the one thing I do love about NVIDIA, enterprise value is very close to the market cap. They have very little debt. That's what's awesome about them. Companies that have very little debt have staying power. If you're committed to this bank and business starts to turn, you still owe that money to the bank. And we've seen interest rates climb and climb and climb. So that causes the interest cost to go up. But for a company like NVIDIA, and a lot of great tech companies today, they keep very little debt on their balance sheet. It makes them less susceptible to interest rate risk, and it keeps the cash in their pocket to weather the storm if bad things do happen. To say that NVIDIA is an incredible company, I truly believe is an understatement. This company is printing money. They're on the forefront of AI for chips. They're considered the leader, and their quality is incredible. Back in the 90s, I was a big computer nerd, and we loved NVIDIA processors and chips back then, and the graphics cards were incredible. That has never, ever waned. It's always been a top-tier quality company. But remember, it is very possible to overpay for quality. Let me give you an example. Ferrari, Lamborghini, Rolls-Royce, Bentley. These are incredible car manufacturers that we all know. There's hard to argue. I don't care if you don't like a certain car. I'm not a fan of Lamborghinis. Doesn't mean that I don't think it's an incredibly high quality company. But is there a price to pay that's too high to own a Ferrari, to own a Lamborghini, to own a Bentley, to own a Rolls-Royce? Of course there is. And I want you to join me in looking at companies the exact same way. Don't look at them as a price going up and down. You're buying a piece of a business. And I do believe you should pay a premium for a high-quality business with a high-quality balance sheet, like NVIDIA. But the question is, what price is too high? There's been a big run-up. Is it a bubble? I don't know. Let's go see what analysts are saying. What are analysts projecting for the future? Guys, it's actually surprising here. Look at this. $11 per share going to $30 a share in the next 4 years. Big jump. But 400 times earnings, close to 400 times earnings, even if it hits us $30 per share, this is tripling. It's still going to be 130 times plus earnings, price per earnings ratio. And for a company that large, it's very difficult. If this company were small, a couple $100 million, growing their revenue and had a long, long runway of growth, I would say awesome. This company has a lot of runway for growth. But at over $1.5 trillion market value, it's hard to really drive that. Let's go look at their revenue and compare it to other companies. You might sit there and say, Paul, it's not fair. Guys, in 2023, $57 billion in revenue. That's what Intel did. Intel did just a little bit above that. I get it. NVIDIA has way better potential than Intel as of what we see right now. But 58 billion, NVIDIA is selling for 10 times more market cap than Intel. That's an incredible number. That's incredibly different. Doesn't mean I'm equating them as companies. It just means a comparison. You look at a company like Berkshire Hathaway. Berkshire Hathaway is valued at 1/3 of what NVIDIA is. NVIDIA in that time period right here made $26.7 billion. Berkshire Hathaway did $400 billion in revenue versus the revenue of $57 billion. And they did $77 billion in net income versus the 20-some billion dollars that NVIDIA did. Yet Berkshire Hathaway is selling for 1/3 the value, the market cap of NVIDIA. That's the crazy part. Guys, apart from a few shares outstanding increasing, it's all check marks. And I don't blame them for issuing shares when their stock price is so high. I'd be issuing shares too. Why? Because, hey, might as well get that cash in and not take on debt. Might as well sell overpriced shares potentially. But look at these PE and 5-year PE and 5-year price to free cash flow. Insane. Guys, they pay a piddly $398 million in dividends. Isn't that adorable? It's adorable. I don't even know why they even bother with that. So the question becomes, what's it worth to us? Now, guys, you've seen me using the software. I love our software. I use it every single day. And there are so many more tools that we haven't even talked about in this software. I love it so much, guys. I want to show you guys how you can sign up for it. So in our software, that's what you get when you sign up. You get the mobile app, everything we're talking about here on your mobile phone. You get the 8 pillars. You get 30 plus years of financial data. You get the stock analyzer tool, which I'm going to show you in just a few minutes. You get exclusive content from us, access to Mo and I, real estate calculator, stock screeners, retirement calculator, and probably one of the most important parts here, chat with like-minded investors. Being a value investor, being any sort of investor is a lonely road. In this community there are thousands and thousands of people in there engaging every day, talking about things they love. We've had over 16,000 people sign up for our software and community over its lifetime. It is so incredibly popular. Guys, $7 for 7 days. Just try it out. Low risk, $7 for 7 days. That's $1 a day. Come to everythingmoney.com. Try it out. Check it out. I'm sure you'll see the value here. All these green check marks versus what our competitors do out there. So come check it out. Stock analyzer tool, which I talked about covering here. I'm going to do a 10-year analysis. Now, I'm going to pull up NVIDIA, what I did in the past. And I can use that. I did that back in September. Now, there's going to be a lot of discussion about what are the revenue growth potentials for this company because they're all over the board. I put in 10, 20, and 30% per year, which is a lot, guys. It really is a lot. Just to give you an idea, at 20% revenue growth for 10 years, it takes their revenue to over $340 billion a year. At 30%, I'm just going to estimate here, an extra 10% per year. You're talking about $600 or $700 billion in revenue from $56 billion today. So it's just an absolute meteoric rise in revenue. Question is that possible? Look at Tesla. Tesla's crushed it, but look at their stock. Their stock's down over 50% from its all-time high, even though things were looking rosy and great at $414 a share, and now it's stuck at $190 and going lower. Okay, I did profit margin, 20, 30, and 40%, and did the same for free cash flow. Is this reasonable? Guys, remember, they're crushing those profit margins and free cash flow now, but you also see a lot of chip companies coming in and creating more competition. When you have more competition, what happens to margins? This is a very, very popular and profitable space. Competitors will enter. Now, what's the appropriate PE and price to free cash flow? I did 20, 25, and 30. Guys, I know it's going to be a controversial comment, and I want to hear your comments below. I know it feels like this is what's the PE and price of free cash flow in 10 years when it's a very mature business. What's reasonable for that? Look at Berkshire, look at Amazon, look at Google. What are their PEs and price of free cash flow? And then finally, I usually do a margin of safety in my desired return. I did 10, 13, and 16, but I'm going to assume a market return of 9% across the board because I want to say, what is it worth based on a market return based on these assumptions above, and then from there, I can apply my own discount based on the margin of safety I want. Hit the analyze button. Guys, I have a low price of $143, high price of $1,800, and a middle price of $550. So guys, if you believe all my middle assumptions, we're not far off. And if you believe all the high assumptions, you should buy this thing all day. But it's your decision to determine what's the appropriate margin of safety to have on this company. So again, guys, $7 for 7 days gets the full access. Go check it out at everythingmoney.com.